Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. American and Chinese negotiators spending the day working through trade tariff policies in Stockholm with little movement so far. The talks come after a fruitful weekend between the EU and the United States. We're going to be taking a deep dive into the latest. On Wall Street, there's still an hour to go here until the closing bell. Let's get a quick check on the popular averages. Right now, they are looking mixed. The Dow's down about 120 points. Your broad gauge, the S&P 500, is down about 0.1%. Tech-heavy NASDAQ is up about 0.2%. Now let's welcome in here. We've got Mark Malik, Chief Investment Officer at Siebert Financial, Washington correspondent Ben Werschel, and our markets and data editor, that would be Jared Blickery, all joining us throughout the show to break down the latest headlines. Kicking it over to you, Jared, to see what the markets are making of all this trade talk, my friend.
Well, Josh, we're seeing a mixed reaction in stocks right now. We'll get to the dollar in a second. That's where the action is. But first, let's take a look at the Dow. As you said, it's down about 120 points. I will show you the intraday price action. It's been red. It started out the day in the red, dipped into the green a little bit twice, and now it has fallen to the red. But again, we're only talking about 0.25%, so not a huge move here. And in the NASDAQ, similarly, a small movement, but it happens to be to the upside, losing steam a little bit. It peaked shortly after the open there. And then the S&P 500, more green in the early part of the day, and now we are just slightly in the red, down about 14 basis points. Also, I'll point you to the Russell, not the Russell 2000, but the S&P 600. Both of the small cap indices also underwater by a similar amount, so nothing to write home about. I did mention the dollar, and that's what I'm going to focus on right now. We are seeing a big upward reaction in the dollar. The euro is weakening, and this is off of those trade headlines that we saw develop over the weekend. And the US dollar index now up about 1%. That is a lot for a currency, especially the reserve currency of the world's largest. That is the biggest gain that we've seen in about 11 weeks. You'd have to go back all the way to May. And so that is having ripple effects across certain asset classes, maybe stocks to a limited extent, but also futures, especially the metals, and also crypto. Before we get to those, let's take a look at the sector action for the day. Energy, WTI crude oil is actually up, so not suffering from that dollar advancement here. So energy is up 1%. Following that, we have consumer discretionary up about 0.2%, and then tech up about 0.5%. Those are the outperformers, the only ones in the green. And then to the downside, we have materials. That's down by about 1.5%. So is real estate, and then utilities and staples each down about 1% as well. So the defensive sectors, except for XLB, defensive lagging the day here. And let's check out the NASDAQ 100. We can see a mixed picture with respect to the mega caps. NVIDIA is up 1.34%. Amazon also in the green. Broadcom up over 1%. Tesla, though, leading the pack in terms of the megas, up 3.5%. AMD, a smaller stock, is also up nearly 4%. And some other outliers here, but nothing too major either to the upside or the downside. And then I'll show you the Dow as well. A split board here, and more red than green. And we're seeing some negative action, price action in the financials from JP Morgan, down 33 basis points. Boeing, though, in the green for about almost 1% if you round a little bit up. And then Chevron up about 0.8%, just kind of playing into that energy, that strong energy theme we've seen today. Here's the futures market. We do see more green than red, and in red, we are concentrated in the metals. So copper down almost 3%, gold also down about 0.2%, silver down just a little bit. I would say that palladium, though, that's up 3%, and I did mention crude oil. Crude oil WTI is up 2.6% today. And I will close with a look at the crypto market and the strong dollar probably weighing just as it did last week when Powell and Trump had their little powwow in the Capitol, and we were looking at a strong dollar reaction to that. That sent crypto down overnight, and we're seeing a very similar reaction right now.
All right, well, more on our top story. Let's get to Ben, who has been keeping a close eye, of course, on the EU trade agreement and U.S.-China talks as well. Ben, what is the latest?
Yeah, Josh. So we've got a lot of trade headlines coming this week that are going to go through all the week. Just to sort of start people off, there's kind of three main buckets, I think, of deals. The complete is the one you mentioned, which is the European Union. That was a deal that was announced yesterday, and we've kind of spent the whole day today trying to figure out exactly what was in it because it was very unclear. We do have some clarity on there now with the White House confirming this afternoon that this 15% tariff rate will be very broad and apply, most importantly, to pharmaceuticals and semiconductors with future niche or sectoral tariffs that are coming there now. So that sort of lends a certain amount of stability, and that's the word the European Commission president has used repeatedly since announcing this deal. That there's a lot of folks that aren't happy with this deal in Europe, but at least we sort of know exactly what the parameters there, more or less, from this European Commission deal. Kind of in process is the China one you mentioned. Talks began today. They just wrapped up for the day in Stockholm, Sweden. The Chinese delegation was seen leaving a little bit ago, and the main focus there is an extension of a tariff pause. If you'll remember, in Geneva about 90 days ago, there was a pause on triple-digit tariffs to our current rate. What markets are looking for is an extension there, as well as a bunch of other issues that are forefront there, especially no backsliding on some of these issues like rare earth minerals and semiconductor export controls, which are top of mind. It's also sort of, hopefully from these negotiators' perspective, set the stage for a big Trump-Xi meeting later this year. And then the third bucket I would add as well is a number of wild cards that I think markets will be watching closely this week ahead of a Friday deadline for reciprocal tariffs. Canada is a big front there. Trump has threatened 30% tariffs there. The Canadian Prime Minister talks about how they're in the intense phase right now. South Korea is another one. Mexico is technically up for tariffs on Friday with no action there. So a lot of different elements going that we're going to be tracking all week.
A lot of moving parts there, Mark. I want to bring you in here as well. What do you make of these market moves today, Mark?
Well, it's interesting. You know, I would have expected to see a more positive response to the EU deal, but I mean, it came out pretty quickly. I don't think a lot of us were expecting it. We weren't expecting it to be as crisp as it was. But I think when people sharpen their pencils, they start to look at it. And, you know, just a couple of weeks ago, we were talking about a 10% effective tariff. Now we've moved it up to a 15% effective tariff. That looks like it's going to be sort of the baseline at this point. But I think when people started sharpening their pencils and looking down into it, they thought, okay, well, these are where the costs are going to come in, and these are the positives, these are negatives. It's kind of like sort of a mixed result, but net, I think it's very, very positive.
All right, Jared, thank you. Mark and Ben, you guys are going to stick around with me here for this next interview. For more, I want to bring in here an expert on economics and international trade. That would be Philip Luck. He served at the State Department during the Biden administration and is currently Director of Economics at the Center for Strategic and International Studies. Phil, welcome to the show. Let's start right there, what we've been discussing here, Phil. The U.S. and EU, we reached this deal. Phil, as an economist, through your lens, good news long-term for the American economy, Phil?
I would say good news medium term because it's reduced uncertainty. I mean, I think the biggest thing that was the problem of the Liberation Day tariffs, the rollouts, and then the will they, won't they of escalating and de-escalating was just a complete lack of clarity to industry about what sort of business regime they were going to be operating under. And this provides some clarity. I will say, though, I mean, this is a very high tariff. I mean, you know, average tariff rates in the United States were about 2.2% prior to, April 1st. They've gone up a lot. I mean, we're moving towards a place where pretty much all of our major trading partners will have tariff rates between probably 20 and 15%. That's going to really increase costs of intermediates, and it's going to reduce the competitiveness of a lot of exports. Now, that said, it's not going to be a deal breaker. This is just going to increase costs.
So one other point I would add as well, Josh, about this is the effect on the European economy. Capital Economics had a note today that calculates that this deal actually will be a headwind for the European economy as an overall by 0.5 percentage point. That's really significant, and that's a lot of why you're seeing such negative reactions here. But I think it's telling how mixed folks are and how a lot of people are positive on this deal, just because, as was just noted, it's not higher than that. The headline on that capital economics piece was that a bad deal is better than what was there before. So I think that's an important element of this too, that this is going to be a clear headwind for America's trading partners, but it's better than what maybe they expected previously.
Ben, can I ask you, have we heard what the member states feel about this over in Europe? Have we heard how Germany feels about this, how France feels about this?
Yeah, there's definitely been some negative commentary. France is one that strikes out. Their foreign minister called it a somber day. So there's clearly a lot of unhappiness with this deal, especially this 15% rate there. And there is an approval process that they will go through. But I think the overall sense here, and you see it in kind of the mixed markets, is that there wasn't a better deal in the offing. Trump has very much stood by these baseline tariffs. They were hoping for 0, then it was 10%, and now he's very much stuck at 15%. He reiterated that today, that his essential global minimum is about 15 to 20%. So there is an approval process, so there's lots of ways this could go sideways. But for certain, it's moving forward, this process for certain.
You know, Phil, one question I have for you as the economist on the panel is, why haven't, Phil, the tariffs negatively impacted the American economy as much as, Phil, some might have expected, as much as some economists even forecast on this show? One theory, I want to get your take on this, Phil, is that maybe there are these offsets that we weren't accounting for as much as we should have, whether it's, listen, tax bill, AI, lower energy costs, but curious to hear your take.
Yeah, I mean, I think some of the commentary was a little over-torqued to the beginning. And I think a lot of that was under the assumption that consumers and businesses would pull back investment and consumption, and that would lead to a real sort of downturn in the economy. That really hasn't happened. The administration has found ways to sort of, slowly increase the temperature of the water, if we're the frog in this analogy. So that really hasn't happened. I mean, look, this is going to be costly as an economist. This is going to increase inefficiencies. It's going to keep certain businesses in business that are inefficient. It's going to stop other businesses from being as productive as they can because it'll increase the cost of their inputs and reduce their competitiveness in export markets, notably because we have not really gotten lower tariffs from other partners, right? So that conditions is the same for our partners. But then the question was, well, why are we not seeing more immediate effects? A lot of these tariffs really haven't gone into place yet. So for instance, the 50% tariffs on copper, that still hasn't happened. And even when those go into place, they have already telegraphed that those tariffs are going into place. The warehouses are full. There's an enormous amount of copper in the United States right now that has come in and pre-positioned. So it's going to take some time for all these things to go through the economy. And the last thing I would say is, look, this is a tax. It's a consumption tax, which is going to impact consumers and low-income consumers more than high-income consumers. But the U.S. economy is actually not that trade exposed. About 17% of GDP is trade. So relative to more open economies like Germany, which was just mentioned, which was in a much worse spot in these negotiations, we can absorb these costs. It doesn't mean we should, but we can.
Mark, as an investor, when you're watching these US-EU headlines drop, you're seeing these reports, do you feel, Mark, as an investor, you're getting enough information, data, clarity from these reports?
Yeah, well, data is really important, and data it's been kind of lacking leading up to this point. I mean, the terms of the deals, basically fit into an index card when clearly these are much more complex. They basically are leaving it all to us to figure out, how it's going to impact a lot of these companies. But we're going to get it. It's forthcoming. But I think at least getting the big picture out of the way, understanding that they're not going to be possibly countermeasures, which were a big part of the negotiations way back in 2019. The EU has got a lot of those locked and loaded. So I think for the most part, we're happy we're not going to witness that. Now, again, as I keep saying, we've got to sharpen our pencils and see what the real impact is. And it's going to be different on each company and in each sector.
Ben, we're talking, U.S. and EU. What about U.S. and China? What are your expectations there, Ben? Are we going to see this trade truce really get extended?
I think that's the high expectation, and I think that's sort of priced into markets at this point. The word Treasury Secretary Scott Bessent, who's leading these talks, has used is likely, and another 90-day extension there, which if things go sideways that way, that would be a major downside risk for the markets as opposed to any additional increase. The other downside risk I'd flag is this rare earths and semiconductors deal. This has been the flashpoint that's kind of held things up for the last couple of months since Geneva. That is still there's still a lot of details to be worked out there. So I think there's a sense that that's being worked out as they hopefully move to bigger issues, including a President Trump and Xi meeting. But they're basically just trying to check off these smaller downside risks as they move on to bigger issues.
Phil, I'll end with you on that U.S.-China trade deal, trade negotiation. Phil, I'm curious, what do you think, Phil, President Trump and the White House would consider a win there?
It's a great question. I think as more and more of these deals have been inked, if you can call them inked, the the pattern that we've seen is basically the administration becoming more and more willing to accept basically promises of payments or investments rather than the things they sort of initially were asking for, which was better treatment for U.S. goods, reductions in non-tariff barriers, and other things like that. If they're willing to go that route with China, this actually may not be that hard to accomplish because, we can essentially have another phase one deal where the PRC promises to do things that they'll never end up doing, and we could sort of get a detente. I didn't think that was going to be the way this was going to go. If they are intent on solving some of the more systemic problems, and if they are intent on continuing to ratchet up the pressure in export controls, I think we've got a long road to go, because if we continue to go down the export control road, so will they. And as was just noted, they really have a real stranglehold over critical minerals, permanent magnets, and other industries that can cause us quite a bit of pain.
Phil, Ben, great to have both you guys on the show. Thank you. And Mark is sticking around for this next topic too. European automakers like Porsche, Volvo, Volkswagen, they're going to see 15% tariffs on all imported cars and auto parts as a result of that recently announced deal. For more on this, we go to Yahoo Finance senior autos reporter. That would be Praz Sumeranian. Praz.
Yeah, Josh, you guys have been talking about it just now for the last 10 minutes. Yeah, that deal now in place. But for the automakers, they got a little pop when we heard reports that the deal was going to happen because there's a lot of anxiety about 25% tariffs on German luxury automobiles. Now it's come down to 15%, so that's better news than what's been going on right now. But hey, that's not as good as the prior situation where it was around 2.5% tariffs for German automobiles. So you saw the stocks of those companies today all taking a step lower, even though the deal is sort of a preliminary deal is in place. There's just a little bit of kind of, it's going to impact margins a little bit. We kind of know what the hit's going to be, but it's just not fully great news here going forward for these businesses.
And these European automakers, Praz, what is the game plan with the tariff? They eat it, they take the margin hit, they pass it along to Praz and Josh, some combination of the two. What did we think?
There was thought that they would, companies like Porsche would try to push the entire tariff costs onto their customers. But as you can see, that probably just was not going to be a good idea because the fact that U.S. consumers were not going to actually absorb that full cost had to become a combination of we take some, the consumer takes some, and then we'll see what happens. So, we've been hearing automakers are pushing around 5 to maybe less than 10% of that cost on to consumers when it was 25% because they just couldn't put that fully on them. Companies like Audi just today announced sort of weaker than expected results in the U.S. And this is not just because of tariffs, but because the product sort of landscape is changing. There's more competition out there. And so that combined with higher prices is not a good situation for European automakers working in America. And they have to sort of stomach some of those costs in order to stay competitive.
It's interesting, Praz, because you've talked about these European automakers on the show. So now they do have some greater degree of clarity and certainty, but talk about the challenges these names still face broadly.
We're in a world where interest rates are still, 8 to 10% for a car. We talked about this earlier today about how that monthly payment has been going up and up and up. And if you're talking about a car, a luxury automobile where, getting out the door with the cheap lease is probably $500-600 a month. You're talking about much more than that when you're financing. So you have that on top of the fact that you have tariffs, on top of the fact that we have maybe somewhat uncertain economy here with just sort of thoughts on what's going to happen in the future. You also have better American products. You have better products from Cadillac that are doing well in the marketplace, linking itself to with the new Navigator, vehicles like that. So you have a bit of a minefield here for European automakers in the U.S. This is their biggest market. They need to be here, to perform well here. But it's a combination of things that are making it a bit more difficult for them. Unless you're a maker of Lamborghini, for instance, right? Those guys are always going to be okay because they only sell, 6,000 vehicles in the U.S. a year. All
right. Thank you, Praz. Appreciate it. And we are just getting started here on Market Domination. Coming up, crypto's credibility and reach continue to grow. PayPal is allowing businesses to accept payments in over 100 digital assets. And how you play big tech stocks will be crucial, of course, this week. We're going to have a special playbook on what you need to know surrounding Mag 7 earnings for your portfolio. And can earnings help United Healthcare stock turn a corner? We're taking a deep dive into what to expect there. Those stories and a whole lot more, that's coming up. Stick with us. It is a big week for big tech with 4 of the Magnificent Seven set to report. Microsoft and Meta, they're coming on Wednesday. Apple and Amazon scheduled for Thursday. Key themes include how big tech is turning AI into revenue and what it's costing them. We're navigating how to play big tech this earnings season with the Yahoo Finance playbook. And joining me now, we got Dan Flax, Senior Research Analyst at Neuberger Berman. Dan, always great to see you on the show. You call out some big themes, Dan. You say investors need to think about for big tech earnings. One would be advertising and engagement. Now, if you looked at Alphabet earnings, Dan, I think you'd look at those results, say, hey, ad market seems to be holding in there, resilient. What do you think we're going to hear on that front from Meta and Amazon?
I think what we'll see is that the digital advertising market is better than we feared a few months ago. There's certainly still a number of cross currents out there, but when we speak to advertisers, they're getting good returns from investing with Google, with Meta. I think Meta will have strong results a little bit later this week. I think user metrics will remain healthy, and the focus there is continuing to innovate, to add value to users on one side, the advertisers on another. And then lastly, I'll round it out with Amazon, where they have a $60 billion digital advertising business, which I think is somewhat underappreciated. Of course, the focus there is on e-commerce, which I think they're continuing to add value to their customers with more one-day delivery with Prime. And finally, of course, Amazon Web Services remains a big focus as well.
Let me ask you, in that digital ad market, Dan, you got the big names, and you called them out, Alphabet and Amazon and Meta. Is there room for the smaller, relatively smaller players too, Dan, like the Snaps?
I think there is. The market's growing, and clearly users are spending more time engaging with the digital platforms. And when we look out to the world with more generative AI, a much richer level of engagement, more complex queries, I think the platforms, including the smaller ones, have the ability to become even more impactful to the constituents. The key, though, is really being able to invest, to innovate, to fail quickly, and keep testing and figuring out what works for, of course, users on one side and advertisers on the other. So I think the pie is growing, which does present opportunity.
And Dan, another theme you call out here is CapEx. Certainly, big tech continues to spend, building out that AI infrastructure. Dan, what do you think we hear on that front from the Metas and Microsofts and Amazons?
I think you'll see the companies continuing to push aggressively in terms of their data center build-outs, buying more chips from NVIDIA, amongst others. And the reason for it is they're getting, if you look at Amazon's AWS business, we saw this with Google Cloud last week. I think we'll see it with Microsoft Azure. They're seeing very strong returns from these investments in newer areas like generative AI. And so that remains early. The piece, and certainly the concern, were the market and the cyclical headwinds to become a bigger force later this year and into 2026 is something we're watching very, very carefully. I think these companies do have existing businesses. Digital advertising is one, cloud, of course, another, YouTube for Google, as we saw, that can absorb some of this capacity. But we're watching it very, very carefully. Beyond, though, this period, the key, as we think about the other side of this current environment, will these platforms be able to add value in new ways? And with Meta, Microsoft, Amazon, and Google, I think the answer is yes, they will. And that sets up for attractive returns from current levels.
Who benefits, Dan, downstream from all that CapEx spend? Is it the name you just mentioned? Is it NVIDIA front and center?
NVIDIA is an incredibly important partner to these companies. And the reason is because not only is it the chips, but it's also the software, it's the tools. It's really empowering millions of developers to write to their platform. And of course, organizations, startups, governments, enterprises are able to tap into a lot of these capabilities on the cloud platforms like an AWS, like a Microsoft Azure, Oracle. That's another cloud where we continue to expect strong growth. Other players, though, for example, Broadcom, have a very important role to play with chips that they're providing to many of these same companies like Google. And so the key is, can the chip makers like an NVIDIA, like a Broadcom, continue to push their product roadmaps, deliver a lot of value to their customers, notably the cloud companies? And if they're able to do that, I think it sets them up well for good growth as we think about the year ahead.
Dan, final trend I want your take on here. You call out the theme of monetizing AI, actually making money from all this. What are you looking for, Dan, on that theme? What are you listening for on the conference calls?
We're looking for where companies are investing in data centers, in chips on one side, and then translating that into growth, into revenue and cash flow from their customers. You'll see it, I think, from Microsoft, which has been capacity constrained, as all the cloud companies are. As they add more capacity, they are generating returns from these newer workloads like generative AI. I think we'll hear a lot about that from Amazon, from Microsoft. We heard some of that from Google last week, and that's going to be a big focus through the rest of earnings and into the back half, because we remain long-term owners of the shareholders of these businesses, but the key is investing and then generating the returns over time.
Finally, Dan, and I don't think we even mentioned this one, so I got to get your take. What about Apple, Dan? You know, I know, listen, the stock's been under pressure year to date. Obviously, some investors are concerned about the company's AI strategy. Your thoughts on the iPhone maker?
So we're in a seasonally weaker period now, but the focus in the next several weeks will be on the iPhone 17 and that launch. What's important for Apple, and we continue to like the name, is that the iPhone install base is still growing. And additionally, you have more and more customers looking for the Pro and the Pro Max. And so that sets up for a durable iPhone franchise on one side. On the other side, you have the services business, which is over $100 billion, which in my view has attractive growth rates over the next 1 to 2 years. And so it's this broadening of the revenue drivers that I think remains intact for Apple. I think Apple Intelligence will get better over the next 6 to 9 months, and I think that will become an increasingly important part of the story. But for the stock, the growth in the iPhone install base and the health of services, in my view, sets the stock up well as we look into the back half and into 2026.
Dan, always great to see and to have you on the show. Thank you.
Thanks, Josh.
All right, now time for some of today's trending tickers. We're watching shares of PayPal, Duolingo, and Meta. Mark Malik, Siebert Financial CIO, is with me. PayPal, she got that name first, the fintech company announcing it will start to allow consumers to pay with crypto, supporting transactions across more than 100 cryptocurrencies. So this was a headline, got some attention. Bloomberg noting the option goes live, Mark, in the coming weeks. It's going to allow merchants to accept crypto. So we're talking Bitcoin, Ethereum. PayPal telling Bloomberg, by the way, you have globally, they told them, 650 million users that participate in the $3 trillion market for cryptocurrencies. We wanted to give small businesses access to this customer base that is growing. Your thoughts on this one, Mark?
Yeah, welcome to the party, right? I mean, it's just a matter of time before they jumped into that party, and it's no surprise, right? So, but you know, there's a reality behind that. I know it's going live relatively soon. I know there are significant benefits for vendors who want to get payments going quicker and cheaper and more cost effective. But you know, what are these 100 cryptos that we're talking about, and how are they going to operationalize that? Is it going to be efficient for PayPal going forward? It's a great goal. It's something that we would expect from them, but you know, we'll have to see how that plays out. Right now, at this point, you know, I'm sort of skeptical about it and think it's a little bit more of a, you know, maybe a PR kind of thing. But ultimately, they have to be there, and so you know, may as well start now at this point. But more detail, like always, is really going to be helpful there.
All right, we wait, see how it plays out. And for those headlines, other name, want to take a look at. So you got Duolingo. It's a popular language instruction app. It's facing a decline in share price as Citizens JMP lowers its price target on that name. So this one, Mark, Citizens tells their clients, okay, we're kind of cautious, it sounds like, on the upcoming results. And you can see stock reaction to today's trade. They say third-party data suggests engagement slowed since April. Slowing growth raises the question of whether Duolingo's TAM is saturated. However, Mark, they tell their clients, we believe this is temporary. They say we expect growth to rebound as we continue to believe this name has a larger opportunity in teaching people subjects that take a long time to learn. They say they view this one as an AI winner. What do you think?
Agree. It's very interesting. I mean, AI really kind of changed the business models for a lot of these companies. Duolingo was a little bit slow to get on board with that, but clearly they're in a space to take advantage of that. And you can see, the stock's response to that. It's kind of been trending down a little bit. But yeah, it's a great opportunity. They are really good at what they're good at. They still have the brand name out there and they still have the footprint. So if they embrace it and they go forward, there's a lot of potential upside there as well.
Yeah, Citizen Still likes this one. It says market outperformed, their target is $4.50. Finally, Meta receiving a price target increase over at Guggenheim. The firm says that investors are expecting good results ahead of the company's second quarter earnings announcement coming on Wednesday after the bell. So this one, Guggenheim has a buy on the name, Mark. Take their target to 800. They say investor confidence in Meta's performance and AI playbook remains strong ahead of this print. They talk about how shares are up around 30%. Since Q1. They see 2 points of focus: top line growth in the company's core ad business and level of investment into business expansion.
Interesting. Last week Google came out with some great earnings from Alphabet.
Very solid, yep.
And it really sort of set the sort of pace for what we can expect for a lot of these other companies. Again, Meta has been doing everything right. I mean, Zuckerberg has been doing exactly what we would expect him to do. He's playing tough. Last time I was here at Yahoo Finance, we talked about it being do or die for Meta, and they're doing it, right? So I think there's a lot of high expectations for them. They're going after top talent. They're going to continue to invest in their data centers. Quite right, and they're going to use AI to enhance their businesses, as we just discussed before. And so there are a lot of high expectations, and they're doing everything right so far. We'll have to see what the results look like.
As a CIO, when you look at a name, I'm just curious, a Meta. Now, Meta's up around 20% this year. Street loves this name, loves this name. It's nearly 90% of analysts who are paid to tell you what to do with. Nearly 90% say it's a buy, Mark. Does that ever get you kind of nervous when everybody seems to be piled on one side of the boat? Or no, the herd can be right?
Well, it depends on what they're saying, right?
Yeah.
So if we back off and we start looking at it, we're not trying to be cute about the investment, and we look at the big picture and we see what they're doing right, what they're doing wrong. We see that management there has been able to pivot when they're unsure about something. They've done it. They did it big time with the metaverse. And we see them pivoting right now into AI. They're leaning into it. They have the smarts. They're doing everything right? So the analysts, what they're saying, if that agrees with what we're seeing on our analysis, that's always a big positive. Now, of course, there's the reality that there's a lot of momentum behind the stock, which is happening because other people are seeing that. We can't ignore the momentum, which means that the message is getting out there. So now it's a matter of them. The bar is raising, so they got to keep backfilling for that bar. So the bar's going higher for sure, but we expect that they're going to do a good job going forward.
All right, earnings on deck. We shall see. Meanwhile, here's another name, United Health Group, reporting second quarter earnings. That's coming on Tuesday. Joining me now for What to Watch would be Yahoo Finance senior health reporter Anjali Kumani. Anj.
That's right, Josh. We know that United Health is going to be following a couple other healthcare companies for the first time, not leading the pack this quarter. It did delay its earnings report this quarter to follow what we've seen with Centene and Elevance as examples. Now, what we're expecting is the street is looking at $111 billion and 53 cents for revenue, as well as $4.59 for adjusted EPS. We'll see how close to the mark they get. They did miss on the top and bottom lines last quarter, but that adjusted EPS from the street is actually a little bit lower than we saw in the past. So that's something to take a look at in terms of what to expect there. We know that there's been an elevated risk, or rather elevated use of medical services in the last year. The industry has really been under pressure for that. And so that's something to take a look at when it comes to United and its earnings.
And Anj, let's talk about another company while I got you. You've been following closer, I know, and that would be Sarepta Therapeutics. What is the latest there, Anj?
That's right. The stock is surprisingly up today after news of the company having to pay out a $100 million milestone to that's correct, to Arrowhead Pharmaceuticals for one of its other muscular dystrophy drugs in clinical trials. But meanwhile, the stock had been hammered for quite a number of days before. If you want to take a look at the timeline of what has been happening for Sarepta and the reason why the FDA is currently looking at it. First of all, we got 2 deaths earlier this year, in addition to an 8-year-old patient in in Brazil, as well as the FDA investigating those other deaths, and then on Friday saying that it was finally looking into the death that was reported in Brazil. Meanwhile, we know that the company has halted its top-selling muscular dystrophy drug as of this month, and the FDA is looking into further that, as well as the EU rejecting, or a panel rather in the EU rejecting Elevidys approval. So a lot of pressure on that stock, despite some of those moments in the timeline. The stock is up today, so we'll have to keep a watch on that one and see how it unfolds, especially to see how the FDA handles the drug halt, which is still an undetermined timeline and one of its biggest revenue drivers. So a lot going on for that one right now.
All right, thank you, Anj. And the odds of a Fed rate cut this week, we know may be slim to none. When we return, we're going to look at what the Fed Reserve's call will mean in this economic climate. Stay with us. That and much more coming right up. President Trump announcing a trade deal between the U.S. and European Union, including a 15% tariff on most European goods to the U.S. New tariffs creating potential questions about inflation and, of course, the Fed's next move with interest rates. For more now, I want to bring in Christian Hoffman, head of fixed income and portfolio manager at Thornburg Investment Management, with $50 billion in total client assets. Christian, it's great to see you. So let's talk about the Fed, Christian. We have, of course, Wednesday's rate decision. Now, President Trump was talking again today. Christian, I don't think you'll be surprised to learn he was again emphasizing the Fed should be cutting. Not happy, clearly, Christian, with Jay Powell. But what do you think, Christian, we're going to both see and hear from the Fed this week?
Yeah, look, the Fed's not going to do anything, and I think Powell is going to continue to dig in his heels, and he has, frankly, firm ground to stand on. He's also, reaching the end of his term. I think it's been relatively clean, and I don't see him bowing to pressure from the executive branch. I think from the executive branch's perspective, you can almost think about this as a hedge. So if he is able to use some moral suasion and actually get rates lower, that will help with growth. And that will, be seen as something as positive from that side. At the same time, if things go wrong, he has a very convenient scapegoat. He can say, I told the Fed that rates were too high, and now this happened. So I think from a cynical framework, you can see how this is playing out. But this is likely going to be status quo for a while.
Yeah, I agree, Christian. There's something to that. I mean, you keep Powell around, and if things go wobbly, you say, listen, see, I told you it was too late, Powell. I think there's something to what you're saying there. So this week, okay, you're not expecting, but what is your base case, Christian, for looking ahead? How many cuts would you expect this year, if any?
Look, I think 1 to 2. But as long as we continue to have all this amount of certainty around tariff and trade policy, it makes the framework for cutting particularly tough. We did have some favorable prints on inflation, but not on the PCE core deflator, which is really what the Fed is anchored to. So we're not getting help there. And the labor market continues to look, fairly strong. So again, it's tough to argue that we should really be cutting rates significantly. There's also a question of, how much does that actually matter? The first 100 basis points of cuts, I wouldn't say the world feels wildly different. And look, you start getting into the mid to high threes, you could argue that is largely neutral territory. So that's not, a tremendous way from here. And how different is that going to feel? Again, we've talked about this a lot, but maybe not as much as people expect due to the particularly long and variable lag of this cycle and the outcome of having, interest rates so low for so long.
So, Mark, I want to bring you in here as well. So Christian says, all right, base case, 1 to 2 cuts this year, Mark. Does that dovetail with your outlook?
100%. Yeah, our base case also is 1 to 2 rate cuts. We don't believe that this is an environment where they have to cut rates. I think if anything, it would be, the market would enjoy it, but it would be a very short-lived enjoyment. I don't think that at this point it makes any sense. What we would like to see a little bit more from the Fed, though, is a little bit more context around what they're looking at, how they're looking at things. Right now, it's pretty much straightforward, toe the line. We're waiting. We all understand that. Hopefully this week we'll get just a little bit more information. I think that'll make us feel a little bit better about our outlooks for the rest of the year.
Christian, what about that point Mark's making? More, generally speaking, more context from the Fed?
Yeah, that's right. Look, if I was in the room on Wednesday and I was allowed to ask a question, I think I'd say, do you feel there is more uncertainty, around the labor outlook or on the inflation outlook? Because again, all the volatility on policy that we're seeing certainly creates some clouds around both of those. But I'd be very curious to see which one the Fed feels even less confident about, at this period of time.
Do you think, Christian, that investors, the markets are in some way at this point looking past Powell? As you point out, next spring, term ends. Are they almost looking post Powell at this point, and to whoever Trump puts in there, who you would expect, of course, to be aligned with the president, to be dovish?
Well, look, there's a lot to unpack there. I think in some ways, when we're seeing these lower rates, come down the pipe, assume Powell had another term, he would probably be doing the same thing at that period of time anyway. So the difference overall is probably being overstated. You've also seen some support at the front end, to your point. So you are seeing some of that benefit, already coming through today. Look, I think the market is looking this as a, potentially a battle between the Kevins. Warsh seems like a long shot to me at this point, given, some of his historic hawkishness. But we also have to remember there's no kings at the Fed, that, it's a 12-person committee. And even though one person is going to have outsized influence, look, it's still mostly the same folks in the room. So it's not going to be, it shouldn't be wildly different, even though it will have a change in tone.
I agree with you, Christian, on Warsh. I think most people think Warsh, they don't think Dove. But I want to get you out of here on this, Christian. For fixed income investors, they're listening closely right now. Your advice?
Look, I think this is an environment where you want to take a Goldilocks approach to fixed income. Certainly fixed income has value in portfolios. You don't have to take a ton of risk to get, say, 5 to 7% returns, which was not on the menu for a very long time in fixed income. That said, reinvestment risk on the front end is very real. You're taking a lot of interest rate volatility if you're taking, duration of, 6, 7, 8 plus. Also, credit spreads remain pretty tight today. So when we got into the 450s during April, there were some attractive opportunities, but we've really given all that back at this point. So I think it makes a lot of sense to trust an active manager who can lean in and out of risk, and find the sweet spots in this market where you're getting nice carry, and it makes sense to stick around and carry that income.
Christian, great to have you on the show today. Thanks so much for your time.
Thank you.
We're charting a new course as we look at the state of markets and the economy. Yahoo Finance's latest edition of Chartbook. That story and more when we return. The 5th volume of the Yahoo Finance Chartbook is coming soon. It's our biannual review of top economists and strategists' most important charts for investors. And joining me now with a preview, we got senior markets reporter, that would be Josh Schaefer. Josh.
Yes, Josh, the 5th volume of the Yahoo Finance Chartbook is here. And essentially what this project is I ask strategists across Wall Street and economists across Wall Street a simple question: what is the most important chart for investors right now? And we can sort of form a consensus of what people are thinking about, what the risks are out there, and what the top things are that for this chartbook have been driving the stock market rally. If we go back to January, a lot of contributors had told us that they weren't necessarily expecting tariffs to be what derailed this rally, right? And that is what did derail this rally. And so this version of the book really kind of takes a closer look at, okay, S&P 500 is back at record highs. How did we get here? And what could sort of propel us further. So I brought 3 charts with us today that I want to highlight that sort of hit on a couple of the key themes from this book. Our first one here is from Mike Wilson over at Morgan Stanley. And what Mike is taking a look at here is S&P 500 earnings revisions breadth. So companies that are raising their earnings guidance, revising it higher versus companies that are revising it lower. Look at what has happened since April, Josh. And if I were to put a chart of the S&P 500, it wouldn't be quite as dramatic, but it would be very similar, right? We've seen a V-shaped recovery in stocks. Then when you take a look at earnings revisions and you also see a V-shaped recovery, a strategist like Wilson will look at a chart like this and say, well, this tells me there has been a fundamental backing to this rally that we've seen in stocks. I think there's been some discussion recently among different members of the media and some strategists that we speak with, why have stocks rallied this much? The S&P 500 is up about 30% since April. What drove this rally? Well, it turns out tariffs, at least for now, are not impacting the corporate profit picture as much as people feared, and that's normally something that would drive people to buy stocks, right?
So that's Mr. Wilson's take on earnings. More broadly, Josh, when you were checking in with strategists, what do they have to say about the rally generally? Where do they seem to stand?
There's definitely a valuation debate right now, right? And sort of the question being, okay, the S&P 500, if we looked at just forward 12-month earnings, is above its 5 and 10-year average, right? Of course, again, the S&P 500 is near 6,400. Can't really go higher. Are we really talking about another year of a 20% rally in stocks? Well, look at this chart from Deutsche Bank's Binky Chadha. I found this very interesting, Josh. So what we're looking at in light green here is equity positioning, essentially where investors are in the market, how much their money is in equities. What you'll notice is that's neutral, right? That's essentially coming in at a flat zero. We're looking at our y-axis over here with where equity positioning is. Chadha points out, as you can see, your dark green line is earnings. Typically, equity positioning would be following earnings higher. You can see how it's chugging higher here, sort of chasing as those earnings estimates go up. Well, look at what we're looking at for the back half of the year, Josh. More earnings growth, right? And so with consensus expecting more earnings growth, Chadha is essentially arguing investors are not nearly as in this market as people think. Goldman Sachs' Ben Snyder also pointed out a similar point. They use their sentiment indicator. Their sentiment indicator's at 0 right now. That would be a neutral reading. And they say they think people can essentially get more bullish. So again, rather than talking about meme stocks and talking about these things that can maybe show us where it feels like vibes are at, when you actually look at where the money is, strategists would argue there's perhaps more room to run because more people can join this rally and come into the rally.
So you talked to strategists. You also talked to economists.
Yes.
What do they have to tell you?
2 key points from economists that I found interesting, Josh. So for one, tariffs were a part of the discussion, but not necessarily a leading driver of the discussion. The key takeaway I found, so we had 4 different economists send us charts on the labor market and specifically charts on immigration. So what we're looking at here in purple is the foreign-born population of the workforce, which I, of course, just made green by drawing over it. And then you take a look at this light green line. This is native-born, and this is your total. What's been happening as these different immigration restrictions have come in from the government, foreign-born is going significantly down. This would be a risk for areas of the labor market that have a lot of foreign-born employees, perhaps construction workers, other areas in the market like that. But overall, just a risk for the market that there will be less workers, right? So does that drive wages back up because there's less workers and there's more competition? Does it impact your unemployment rate? Is it an overall market risk? Mark Zandi from Moody's, who gave us this chart, said this is one of the key things he's watching when he thinks about second half growth and whether or not the U.S. economy will continue to outperform. How much does this impact it?
All right, and of course, the big jobs report on deck as well. Thank you, Josh. Coming up, we are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.